We're getting closer to the end of our budgeting journey, and in this video, we'll be preparing the budgeted income statement. We've already completed the following budgets for Gratman Manufacturing Master Budgeting Process: sales budget, production budget, direct material budget, direct labor budget, manufacturing overhead budget, ending finished goods inventory budget, cost of goods sold budget, and the selling and admin expenses budget. We're going to use many of these budgets to produce the budgeted income statement. Why is the budgeted income statement so important? It helps management determine in advance if their plans will result in an acceptable level of income because it shows the expected profitability of the company's operations for the budgeted period. It also provides the basis for evaluating the company's performance moving forward, which is connected to controlling function of management because it allows the company to measure performance against their original plan. And it works as an early warning system in that if profitability is not acceptable, management will need to consider how to reduce expenses or increase revenues. The structure of the budgeted income statement is similar to the general format of all income statements. For a manufacturing firm, we'll use a multiple step, also called a classified income statement, starting with the company name, the name of the statement, and the period covered, such as for the month ended, quarter ended, or year ended. We then move on to the body of the statement with the sales revenue, less cost of goods sold, which is, of course, the cost of all the products sold. Sales revenue minus cost of goods sold is equal to gross margin, also called gross profit. If we then deduct the selling and admin expenses, also called operating expenses, which are all period costs, we end up with income from operations, which is also called operating income. We take the income from operations and we deduct the interest expense. In budgeting, where do we get the interest expense? We get it from the cash budget, which is a topic for a future video. However, it's still good for you to know now that interest expense in budgeting comes from the cash budget. Income from operations minus interest expense is equal to income before taxes, also called income before income taxes. We then deduct the income tax expense, which is calculated as the income before taxes multiplied by the organization's tax rate. Income before taxes minus income tax expense is equal to net income, also called net earnings or profit. This is the standard structure for a multiple-step income statement, which you should recognize from your introductory financial accounting courses. Let's apply this to an example. We'll continue with our Gratman manufacturing example and use many of the budgets we've already completed to prepare the income statement for the quarter. We could create an income statement for each month, but we'll demonstrate using just the first quarter. Step 1 is to, prepare the budgeted income statement. We'll start with the title, Gratman Manufacturing, the name of the statement, budgeted income statement, and the date, quarter ended March 31st. First, we're going to put in sales revenue, which we obtain from the sales budget. The first quarter sales revenue is $7,950,000. We'll transfer that into our budgeted income statement, $7,950,000 for sales revenue. Next, we have to determine the cost of goods sold, which we'll get from our cost of goods sold budget, $6,905,900. We'll transfer that into our budgeted income statement, cost of goods sold, $6,905,900. Sales revenue less cost of goods sold is $7,950,000 minus $6,905,900, which is equal to a gross margin, remember, also called gross profit, of $1,044,100. We then need the selling and administrative expenses, which we of course get from our selling and admin expenses budget. Looking at the total for the first quarter, it's equal to $366,000, which we're going to transfer into the budgeted income statement as the selling and admin expense, $366,000. We now calculate the income from operations, which is the gross margin of $1,044,100 less the selling and admin expenses, $366,000. So income from operation is $678,100. Note that this is also called operating income. But what about the next line, interest expense? Where does it come from? Interest expense, or interest income if we earn any, comes from the cash budget, which is one of the last budgets we produce, one which we have not as yet completed. Right now, we'll use a question mark as a placeholder. Income from operation less interest expense is equal to income before taxes, also called income before income taxes. We can't calculate it now since we don't have the interest expense, and therefore we don't know the income before taxes, but we'll use a question mark as a placeholder. Next, we have to determine income tax expense. Where does that come from? We have to calculate the income tax expense by multiplying the income before taxes by the prescribed tax rate. But that can't be determined until we know the interest expense, since the deduction of the interest expense affects the calculation of the income before taxes. Again, we're going to use question marks as placeholders for now. This means we can't calculate net income either. We'll have to revisit the budgeted income statement in the future when we have more information for Gratman Manufacturing, which will happen when we complete the cash budget, a topic for a future video. I know I say this at the end of every video, but thank you so much for watching.